Hello, my name is Magnus Petersen. This talk is about stop loss strategies for the S&P 500. The talk is based on this book, and you can click on the image or the link below the video. The book has several adaptive strategies for annually rebalancing between the S&P 500 and US government bonds. The stock weight is a part of the portfolio invested in the S&P 500, and it is calculated using the price-to-book ratio for the S&P 500 and the bond yield. Historically, the strategies had limited losses during the period 1978 to 2013, but future losses may be greater because strategies are sometimes fully invested in the S&P 500 if the price-to-book ratio is low enough. So if losses must be strictly limited, then we must use stop-loss orders. For example, if the S&P 500 drops minus 15% below the purchase price, then we sell it. And if the S&P 500 again increases above the stop price, for example, minus 15% below the purchase price, then we repurchase the shares of the S&P 500. The stop loss strategies also use annual rebalancing between the S&P 500 and US government bonds. The stock weight is calculated using the price-to-book ratio of the S&P 500 and bond yield. After each year, the portfolio is rebalanced regardless of the price of the S&P 500. The number of crossings of the stop price is important because there might be frictional costs whenever we cross the stop price and have to sell and repurchase the shares. This histogram shows the number of crossings per year for each year during the period 1978 to 2013. The stop price is 15% below the purchase price. As we can see, many of the years have 0 stop price crossings, but some years have up to 30 stop price crossings. We may not be able to sell and repurchase shares of the S&P 500 exactly at the stop price, so there is a frictional cost which we can model as a penalty factor. Let's say that each crossing of the stop price incurs a penalty of 0.5%, and this compounds in the number of stop price crossings. So to calculate the return penalty, we have this formula here. For example, if there are 15 stop price crossings in a year, then the penalty factor is calculated as this, and it is 0.928. So if the return without the penalty is 5%, then the penalized return would be a loss of 2.6%, calculated as this formula here. And this is because every time that the stop price is crossed, there is a penalty of 0.5%, and for 15 stop price crossings, the compounded penalty is quite a lot. So it is very important that we can sell and buy very close to the stop price. So now let's look at the stock weight for the medium risk stop loss strategy. And it is a part of the portfolio which is invested in the S&P 500, and the remainder is invested in US government bonds with 1 year maturity. And then after a year, we rebalance using another stock weight. So the stock weight is calculated using this formula. It is 1.93 minus 0.44 multiplied by the price-to-book ratio of the S&P 500 minus 3.14 multiplied by the bond yield for US government bonds with 1 year maturity. And this is then limited to be between 0 and 1. And if we use the historical data between 1978 and 2013 for the price-to-book ratio and the bond yield, and we plug it into the formula for each day, we get this plot over here. But remember that the rebalancing is done annually. So let's say we start investing on 1st of January 1990. Then we look up the stock weight here, which is something like 0.7 maybe. During the next year until 1991, we use the same stock weight. We don't change it during the year. So let's look at an example on how to calculate the stock weight. On January 12, 1990, the price-to-book ratio was 2.31 and the bond yield was 7.8%. So we use the formula from the previous slide and we plug in the numbers for the price-to-book ratio and the bond yield, and we get 0.67. And this means that 67% of the portfolio should be invested in the S&P 500 and the remainder in US government bonds with 1 year maturity. We can backtest the medium risk stop loss strategy for all possible starting dates and investment periods up to 10 years during 1978 and 2013. And this box plot shows a distribution of annualized returns depending on the number of years of investing, which we have down here, and we have the annualized returns over here. So for example, for 1 year of investing, the lowest return was a loss of about 15%, and the highest was something like 72%. The median was about 10%. And as we can see, the distributions get more narrow as we invest for more years. We can also show this as a table where we can see more details. So we have the years of investing out here. We have the minimum annualized return in this column here. We have the first quartile, the median, the average or the mean, and the third quartile and the maximum and the standard deviation. And the probabilities will be discussed on one of the following slides. So for example, if we were investing for 2 years, then the minimum annualized return was a loss of 10.2%, and the average was 11.2%, and the maximum was 41.9%. And for 10 years of investing, the average was 10.5%, and the minimum annualized return was 2.2%, and the maximum was 20.1%. So let's look at the long-term relative performance. And we have the red line here is the S&P 500, which has the dividends reinvested. And the blue line here is investment in US government bonds with 1 year maturity. And after 1 year, we reinvest in US government bonds again, and so on and so forth. And the black line is a medium risk stop loss strategy. So what we can see is that it performs somewhat like the S&P 500 until 1995. And then it avoids the large peak and the following crash around year 2000. And then they are almost the same again. And in the following 5 years or so, the S&P 500 increases much more, and then it crashes again. And after that, the stop loss strategy and the S&P 500 are almost the same. So we avoided 2 large crashes, and the end result was that the stop loss strategy performed about as well as the S&P 500. But what about shorter periods? So let's look at a starting date of 3rd of March 2000 and 10 years of investing. And again, we have the red line is the S&P 500, and the blue line is US government bonds, and the black line is the stop loss strategy. And we can clearly see 2 flat periods here around year 2003 and 2009. And this is where the stop loss had effect. And the end result was that the stop loss strategy performed a lot better than both US government bonds and this S&P 500. So let's look at an example where the stop loss strategy performs a lot worse than the S&P 500. And this 10-year period starts in 1990. And it was a period of a great bull market for the S&P 500 from 1995 or so until 2000 or so. The stop loss strategy underperformed the S&P 500 because it was not always fully invested in the S&P 500, because the price to book ratio became increasingly high in the latter years, and the strategy deemed it too risky to invest too much in the S&P 500. So let's look at the probability of underperformance for the medium risk stop loss strategy. So we have the number of years of investing over here, and we have the probability of loss, that is the probability that the annualized return is less than 0. And for 1 year of investing, the probability of loss was 0.15 or 15%. And this gradually decreased, and for 5 years or more, the probability of loss was 0. And over here, we have the probability of underperforming an investment in US government bonds. And for 1 year of investing, it was 0.23 or 23%. So almost 1 out of 4 investments would have underperformed US government bonds within a year. But as the investment period gets longer, the probability of underperforming government bonds gets a lot lower. And after 10 years of investing, the probability was about 2%. The probability of underperforming the S&P 500 is given over here, and it was quite high at 55% up to 72%, depending on how many years we were investing. The conclusion is that stop loss can be used to increase the average return while limiting losses. But the stop price may be crossed many times during a year, and frictional costs may be high. So it is very important that we trade close to the stop price if the strategies are to work. The book gives more details and it also studies other strategies. You can click on the image or the link below the video.